A very good evening to everyone. The person we have with us today is a markets guru, if I may say, one who grew up in Lucknow, but spread her wings across the world and runs one of the most successful PMSs apart from many other things in First Global. Welcome to Business Standard BFSI Insight Summit and agreeing to be part of this fireside conversation. You, if I may say, you are the only lady participant in a fireside conversation at this summit. So, so let me start the discussion with you on the Indian equity markets. What's your overall take? I mean, what's really happening? A lot of people say that, oh, this is a market that is in a bubble zone till recently. Then people started saying, oh, the premium is too high. US elections have happened. So can you put the Indian equity market in an overall context to start with, given the fact that it is seen as an expensive market, that there are geopolitical tensions all around, US elections have just had, you have a Fed in the US who said that the US president cannot sack me, he has cut the rates, he does not know how will the next rate cut happen. So there are uncertainties and also there are certainties. So in that context, how do you see the Indian equity markets evolving? Devina.
Hi, thank you Business Standard for having me. And I must say, and congratulations on your Golden Jubilee.
Thank you.
And I must say, Business Standard has been my favorite pink paper for several decades. So
okay, thank you.
Not because I'm speaking here, but that's the truth. And I wish I was not the only woman. I mean, I've been this only woman in too many places, too many times, right from the beginning of my career when I was the only woman in the entire Citibank investment bank.
Wow.
And so it's not good that so many years later, I'm still only woman here and there. Coming back to what you who have asked me, actually my stance has not changed much over the last quarters and months. In fact, I tweeted recently that a lot of fund managers suddenly seem to have found chinks in the Indian macro economy, whereas the data has not changed. The data was exactly what it has been and which I've been pointing out the chinks for a while. But having said that, coming back to the markets, you have to step back, and I'm a very data-driven person, and look at the data. And if you look at the data, we all have in our minds that the Indian market gives you in equities something like 15.5% return, because that has been the return since, let us say, Sensex started, so 40 odd years. But equities are inherently volatile. We know this in theory, but in practice, we forget. And they are not volatile just on a month-to-month or year-to-year basis. The variations are very high on even a very long-term basis. So I'll give you an example.
Sure.
I said this 15% odd, but if you look at 2010 to 20, that decade, we compounded just over 8.5%. So we got only fixed deposit returns for a whole decade. And that doesn't capture the difference really. It is like in 2011, if you had put in 100 rupees, in 10 years you would have got 230 rupees.
That's right.
Whereas in 1980, if you had put in 100 rupees, in 10 years you would have got 700 rupees.
Yeah.
So this below par performance is what created the room for the bull run we have seen since the COVID lows. And we are, if you look at the large cap mainstream indices, we are still not above the trend line. So the risk of a sustained crash is when you are far above the trend line. So my stance for the last couple of quarters has been that yes, you will see a correction, but I don't see a sustained crash. And corrections always, when it's going on, it seems like the worst thing in the world. But I was looking at last 16, 18 years data. Nearly every year you've had a double-digit correction. We've still not at double digits yet.
Yeah.
So barring, I think, 2 years, almost every year you've had a double-digit correction. So that's the nature of equity markets. That's the animal. And when you have below par performance is when you get that big boost. So if you go back in history, 1994 to 2003 is the only 9-year period in Sensex history where the net returns were zero. 9 years. And 2003 to 7, then the market went up 6 times. As
That's
part
right.
of an overall emerging market move, emerging market index itself.
Where all
went up.
boats were climbing.
Yes, so I mean so you in equity markets you have to be patient, but you know when things are a little uncertain, it doesn't make sense to get out of the market. You know, all of us understand the risk of being invested, that you can lose some money, but there's also a risk to not being invested. So you have to manage with risk controls, but being out of the market also has its risk. So this again over 40 years, if you look at, if you miss out on 10 best days, you would say 40 years, 10 days, how much will it matter? But it takes away 2/3 of your returns, 2/3.
Right.
And if you miss out on 30 best days, this is 10 best days, so if you miss out on 30 best days, which is less than a day a year, you miss out on 90% of the returns.
Okay.
So if your 100 rupees had become 80,000, now it will be below 8,000. That's the kind of difference. So that's why, and most of the these sharp up move days come when there is uncertainty, when there is fear. They don't come in the middle of a bull run. The only ever time they came in the middle of a bull run was the Harshad Mehta Teji, because that was a rigged market. In a normal market, it hasn't happened even once that you get these sharp up moves. But having said all of that, one other thing which I have been warning about is that there are enough areas in the market where there is froth. So those are areas you have to be careful. So whether it is the IPO frenzy where everybody is thinking it's a lottery, I just buy and I flip out. I mean, the STEBI data showed that more than majority of the people just flip out within a week of listing. And then there is like small cap, micro cap. Not that all small cap and micro caps are bad, but you know, when this kind of mad run comes, the good, bad and the ugly, everything goes up. And people forget, and I said, don't forget this, that of all the companies that have ever been listed in India, more than half have gone to zero. They no longer trade. I mean, there are only 4,000 odd companies that trade in the markets. In the 90s, there were years when there were 1,200 listings and 1,300 listings. So they have all disappeared into the wild blue yonder.
Okay.
So we have, like in our PMS, for instance, we've remained invested, but we have got out of a lot of these frothy areas. And even though we knew in the short term it would hurt performance, you know, we've reduced anything below 5,000 crore market cap. Normally we used to have 14-15% of our PMSs there. We went down to 5-6%. So yes, sure, in the short term it hurts you. But we always manage for risk first, because investing is a loser's game.
Okay.
So those of you who have never read this, just Google The Loser's Game. It's a 1970s article by Charles Ellis. It's a mind-opening article that everything in the world is a winner's game or a loser's game, and how you play the game depends on what kind of game it is. And investing is now a loser's game. So the first objective is not to lose. Not to lose big money. I mean, you will always lose. Equity is a risk asset, so be prepared for some losses, but don't lose big money.
Okay, this is a new message that you are getting, you know. I mean, I don't want to name them, but we had another panel on markets participants, and we got the impression that equities need not necessarily be a loser's game. Now you are bringing in a new perspective, but along with that you are also bringing in this new index of sort, which is a sustainability index. Now from a sustainability point of view, how do you see the Indian market in terms of how far is it towards the top of the unsustainability, or how closer is it to the sustainability? Where do you see it from a sustainability point of view, and what are the factors that contribute to the sustainability and which detract from the sustainability? Could you like to?
Yeah, so one thing, of course, as I said, if you look at in context of the historical returns, we are not very far ahead. If you look at people like to look at PE. PE is a very crude measure. And I don't like to look at market PE, but if you look at sector-wise PE, because see, the composition of the indices have changed so much. People don't realize that. You know, there was a time there was no financial stock or bank in the Sensex, and now, you know, that's the largest weight. Or there was a time when there were so many PSUs in the Sensex and Nifty. There was, you know, ONGC, BPCL, HPCL, IOC, BHEL, VSNL, MTNL. Then there was a time people forgot that PSUs existed. But if you look at sectorally, yes, we are not at very low ends of the PE, but we are not at the extreme end either.
Yeah.
So that's one part of it. And India has always been an expensive market. I mean, you mentioned at the beginning in the opening remarks, yes, India has always been an expensive market. But I don't think we are in really dangerous category, provided you choose carefully. I mean, there have been, as I said, enough areas where there's been froth. I mean, I always say it's, and only half flippantly, that the rule of thumb to identify which are the frothy areas in the market is look at where the thematic funds and schemes are being launched.
Okay.
It is almost always the peak of that theme. I mean, people, the layperson thinks that all these funds are launching, whatever it is, defense, PSU, industrial, that means they see great potential in this. No, they say great potential of gathering assets. Okay. That is all.
That's right.
And normally you launch that fund because it, by the time the retail guy has heard of it, most of that cycle is past. But then that guy has FOMO, that my friend has made money in this, so I must get onto this bandwagon, so it's easy to gather assets. I mean, to my mind, it is a type of mis-selling.
Sure.
I always think that you must always think of whether the investor is going to make money, not what is going to make fees for you. I'm like against that kind of thinking, but that is what drives most of these thematic fund launches.
Okay.
So, and that's, as I said, a good thumb rule to decide where there is froth.
Yeah, but before we end the external sector scenario building, one question, you talked about the US. Maybe you can speak a little more on the US and its influence on the Indian markets. And can you also let us into this thing of the China factor? How much of a China factor is important, and as investors should be wary about? People keep talking about, oh, China mein stimulus ho gaya, paisa bahar chala gaya. How do you look at both the US and China through different prisms or the same prism? Can you let us in into that?
First of all, for the Indian market, if I look at, I mean, this is a question I get asked all the time in TV interviews, that where do you think or how much do you think the FII flows will be, the foreign portfolio investor flows will be? And my question is always that, have you looked at the data whether there is any correlation, let alone causation, whether there's any correlation between the FII flows and what happens to Indian markets? And I've seen it from the beginning. In fact, the reason why I started this business exactly 31 years ago was
congratulations.
Thank you. So October is when I completed 31 years, and the one main reason was Dr. Manmohan Singh's budget, which opened the market to foreign portfolio investors.
Okay.
That was the immediate trigger. And I said, now the market will professionalize, because before that, professional research did not exist as a discipline in India. But
and you were in Lucknow at that time?
No, I was here. I was working for Citibank.
Okay.
So from Lucknow, I went to IIM Ahmedabad. Then I came to Citi. I said, I was in Citi. I joined Citi Investment Bank, and then I was in the corporate bank at the time. And so, but the point being, at that time, one did monitor FII flows coming in. And at that time, this was a new slew of money. It did not exist earlier.
That's right.
Domestic mutual funds practically did not exist. Retail participation was far lower. So what would you have said? That this new billions of dollars are coming in, it will just take the market to God knows what heights. But what really happened? I just told you, 1994, which is
2003.
There was no return.
No
the
return.
market had already gone up before the
So
FII.
here's a warning for you guys.
So I no longer monitor FII flows from the market point of view. Of course, they have an implication for the balance of payment and external account. That's different. But I always say, I remember this school teacher of mine, I'm a maths teacher, and I always, she just passed away last month, and I always, whenever anybody praised me later in life, I would always send a silent thanks to her. And she always used to say that every step you must see that whether this step implies the next step.
Okay.
And here you are making an assumption that, yes, of course, if FII money comes in, market will go up, but have you even checked whether that happens? It doesn't happen. So there is no correlation between, and so this time, of course, last month it was coincidental that, yes, FIIs took out money. And so, I mean, the explanations are, I would say, always made up in a sense.
Okay.
I was reading this book, very well-known book called Business Adventures. And both Bill Gates and Warren Buffett have talked often as one of the best books ever. Now, this talks about a series of various business stories, essentially, in the US from 1930s to 1960s, and the pattern really repeats. So you will see, someday when the market has suddenly crashed, there are very good explanations as to why this happened.
Okay.
Next, when the market zooms up, there are equally good explanations as to why that happened. So equity markets, you have to take the long view, and always, you have a good equity allocation, but no man, this time, sometimes people ask me that I'm young and I have a good job, so should I put 100% in equity? No, you should never put 100% in equities either, because, you might lose your job, you might want to study further, you might have an emergency, you want to put a down payment on a house. Basically, there can be unexpected outflows. So don't put 100% in equity, but whatever is your equity allocation, don't change it too often. There are only some outlier times when you see that there is an imminent crash. And this is we are on record on Twitter on March 2, 2020, saying this time something strange is happening and we are going totally risk averse.
Yeah.
So we went, whatever, we bought hedges, we went into cash, both in India PMS as well as our global funds. And in that COVID crash, when everybody lost 30 to 40%, we lost only 8 to 10%. But in 3 weeks, we also made a call saying time to be back in after that vertical fall.
So China and US, how big are the factors?
So that's why I'm saying, why are you trying to gauge that? Because you're trying to estimate how much will be the foreign portfolio investing flow. So that was why, in that context, I had given this answer. China factor, I think where it will be important is what happens to the Chinese economy is important for commodity demand and prices.
Okay.
So I would, rather than the markets, I think that's the more relevant thing, because the construction in China has been the big driver of so many things, including steel demand, for instance, for decades. And they have a structural issue now because the population is shrinking. So it is not as if that stimulus, say, if those many housing units are not required, then how will that help? Chinese market, again, is a different thing. Now, China is, again, a very good example of a disconnect between the macroeconomics and the markets. Now, Chinese market made a high in 2007. Since then, the Chinese GDP has roughly gone 7 times, and the market has still not reached that high.
Yeah.
So the disconnect can be as stark as that. And it is not India versus China, because remember, China is a very large component, the largest component of the emerging market index. So if China goes up, actually the emerging markets begin to look more attractive. And again, you can just as well give the logic that because of that, more money will come into emerging markets and come to India. So as I said, whatever happens, you can find a very good explanation. There's a book called Everything is Obvious Once You Know the Answer. So that's...
Are you saying that the bull run for India is over? A lot of people say that a bull run normally runs for 5 years, and India has run a bull run for quite some time, more than 5 years now. So are we seeing an end to the bull run, or how do you see the bull run sort of shaping itself in the coming months?
So I'd like to answer in 2 stages. One is the time frame you have. As I said, it can be that I'm not saying the market will not go down from here. Obviously, it can go down.
Yeah.
But for the large cap or mainstream stocks, I do not see it as a sustained crash. So, 1-2 year basis, I'm still positive.
Okay.
However, a lot of the stocks that have done well, which is particularly, as I said, the frothy areas, the small cap, micro cap, many of those stocks never come back. Even now, while the market was not down in double digits, there was a long list of stocks circulating on social media, which were down 30, 40, 50%, even more. So, and I also, there's this data like 2008-9, if you look at the small cap index, it fell almost 80%, 78% to be exact. And then it took 8 years to come to that level. But that's also theoretical that it took 8 years. That index changes 18-20% every year. So in 8 years, it's a completely different index. So those stocks that fell actually never came back. Then 2016 to 18 was another mad bull run in small caps.
Okay.
It fell another 2/3 after that. And I said, don't forget your school mathematics that if something falls 2/3, it triples, you're still at zero.
Still at
So
zero.
all the small cap managers who until recently were saying, I have given 50% return and 60% return in 3 years, if you go back 5, 6 years, the picture looks very different because they lost 90% of the client's money. I said, if you're down 80%, then you compound 50% for 3 years, you're still down 25, 30% from the top. So, you know, people don't do the math. They don't think about what is, and as I said, you know, those stocks, you cannot manage the risk.
That's right.
Because the stop losses don't work. When they fall like a stone. And you cannot hedge. You know, like for example, if we have some uncertainty, we hedge our PMS portfolio. But the only liquid hedge is a Nifty put, which Nifty doesn't move along with these small caps.
Okay.
So be very careful on that side because there are no exits when those stocks fall.
Okay, the message is that you have to be careful.
Yes.
At this point, it probably is the right time to enter into your take on the IPOs market. You know, India's IPOs market is booming. You know, there's issues after issue, and yet when they are listing, many of them are causing some disappointment. What is your take on IPOs, and how do you think investors should negotiate this IPO surge?
So, I mean, this IPOs, when they are in fashion kind of, when there is an IPO frenzy, it is very difficult to do anything sensible there. Because if any business is good and is priced sensibly, you are unlikely to get any allotment at all. And as I said, people were not even making a call on whether they are investing in a company. You think this is a lottery process of some sort. And the SEBI data showed that majority of the individuals, not the fund, but the individuals flip out within a week.
Yeah.
So that's always dangerous territory. And so we don't even look at that. And always remember that IPOs are how coveted an IPO is, how much oversubscription there is not a good indication of what the future of that company is. You know, DLF was a very coveted
classic example.
And never came back to that level. Reliance Power, another classic example.
Which brought about the...
Yeah, exactly. So, I mean, that was like everybody wanted in. So, and on the other hand, you know, recently in another, was watching a podcast and somebody was talking about, you know, parents and grandparents investing, and he said maybe somebody's parent was lucky enough to get an allotment in the Infosys IPO. So I told that journalist that, do you know that the Infosys IPO was undersubscribed? It devolved on the underwriters. And it was eventually those underwriters which made a lot of money, and I'm being prominent among them. Yeah. So, I mean, that was an undersubscribed IPO. So nobody was lucky enough to get allotment. So, you know, that whenever there is a frenzy in something, it is very difficult to get anything sensible there. Because IPOs, they would be sensibly priced good IPOs, but then, you know, you are unlikely to get a allotment there.
That's right. Which brings me to the question of regulation. Is there something that you find not up to the mark or catching up with what is really happening, whether in the IPO market or in the overall capital market? What is your take on the level of regulation, and are we somewhere where it is an ideal position, or there is something that the gap remains? Could you let us into your assessment of the regulation?
I think the regulator is doing a fine job. I don't see a gap there, and they have even been warning where they see things going wrong. And of course, they're now changing in the FNO market, which I think, of course, required a change. If you look at the derivatives
tough
market.
Steps, you know, tough steps have been
taken. But I think those were required, because if you look at the data, not only is it that 93% of the people lose, but if you look at who are the 93% and who are the 7%, the 7% is the big money. It is the foreign portfolio investors. It is what they call, you know, basically proprietors, which means again large players. And the people losing are the individuals. And within individuals also, if you see, the younger people lose more, the less educated lose more. The people with incomes below 5 lakhs, which is less than 40,000 a month, I mean just about 40,000 a month, lose more. So it is all the unsophisticated people who are losing, and the sophisticated investors are making money in the FNA. That's in short the SEBI data. If you parse it out, that is what it is. So that's, I mean, so SEBI is, I think, doing what it can. I mean, people also have to have some sense. I mean, if you look at that like a lovely book of John Kenneth Galbraith on a short history of financial euphoria. And he says that every time a bubble bursts, you look for villains and you want to hang the villains, whatever it is, the broker or banker or whatever, depending on the nature of the financial bubble. But he said the people who are not blamed and probably should be blamed are also the common speculator, because you were greedy, you wanted this quick money. I mean, in this whole boom, I had people coming to me and saying, why are you being so conservative? Why do you manage for risk first? I want to be aggressive. I want to take high risk. I said, with high risk, only thing that is certain is high losses, high returns are not certain. Don't think that high risk means you'll get high returns.
So you are a very conservative investor.
Yeah, I mean, always risk management first. That's why I said investing is a loser's game. You win if you don't lose. So first, I mean, you will lose, you will have some interim losses, but you should not have big losses on your capital which cripple you.
Okay, before we invite some questions from the floor, let me ask you this question. It's a personal question. In a sense, you run a PMS, which I understand depends a lot, hell of a lot on artificial intelligence.
Right.
Now, it raises many questions. One, the role of technology, imminent role of technology, you cannot stop that. And yet, what would be the future like with such rapid spread of artificial intelligence, even in managing a PMS? What is your perspective, and why do you do it, and what do you think is the direction going forward?
Okay, so we use AI and machine learning not because it is available or it is fashionable. It is because what is required in the market has changed. The analogy I give is that you all know India's national game is hockey. So why is it hockey if we haven't, we have only started getting bronze medals after 40 years? So why is it hockey? It is hockey because from 1928 to the 70s, India and later on India and Pakistan dominated hockey. Dominated to the extent there were 2 Olympics where India did not cede a single goal all through.
That's
from
right.
the beginning till the end. So what changed in the 1970s? The hero se zero kaise ban gaye? So what happened was that the playing field changed literally. From grass you went to AstroTurf, the skill set required change. So this superb stick work of Major Dhyan Chand didn't work anymore. What worked was you had to be very fit, very fast, which Indians were not that good at. So similar thing has happened in investing.
And the rules of the game itself.
Right.
The penalty corner go,
right.
everything
And the same thing has happened in tennis also.
Tennis also, yeah.
So I mean, in the interest of time, I will not give that example. But so if you look at investing, for example, something fundamental has changed there too. 25 years ago, the edge was an information edge. You go and meet companies, you get some differential information, and I love doing that. I was just, I met somebody from a steel company this morning, a client, and I was telling him that, I have seen your plant, I have seen half a dozen other steel companies' plants. I have gone to Renukut to see, Hindalco's aluminum plant. I have taken overnight trains to see cement plants, and I loved all of that. But now the rules have changed, the game has changed. Now information arbitrage is not the thing. 1990s, let alone smaller companies, a Tata company, a Tata Steel or a Tata Motors, you write a negative report, they won't call you for the next quarterly meet. But now by law, all data is there on the website. All of you can access it. So now the data is available, the brightest people are in the market. So what is the edge? The edge is who can analyze this masses of data well, without bias, without noise, because human judgment brings noise and the bias. So if you read Daniel Kahneman, he clearly says in any business of judgment, system will always outperform human beings, even in things like judicial decisions. So that being the case, that's what we're trying to do. But see, a lot of people just use the word AI. I say, like, sometimes people ask me, do quant methods work? I said, if I ask you, are financial models made in Excel good or bad? You'd say it's an absurd question. Excel is just a tool. It depends on what you put in there. And I said, AI, ML are also tools. It depends on what you do with it. And we use an extremely rigorous system, but we do not use a black box system. So anything the ranking goes up or down, we can always drill down and see what factors have changed, what is driving this. And you need the market expertise besides the tech expertise.
And you think this will spread fast?
See, spread will be all kinds of quality. Quality is the question. You know, even when I was doing human research, this is very few people really have, Ashokji, you go into the depth, want to really understand what's going on. That's my driving force. My driving force is learning. That I must understand, I must learn. So that AI ML ka label many people will put, but just as an Excel sheet, what are you putting in there? How much thought is going there? How much rigor is going there? I mean, we've been using this human plus machine moniker for a while, and I saw two funds or schemes being launched with man plus machine. Ek to human ko man kar diya, a man with machine. I said, you can't think of
that itself is problematic.
I said, three-word title you can't think of. Then you're going to do that rigor of my quant team is extremely rigorous on every step. So, you know, even data cleaning takes up 60–70% of the work. But the point is that because you're still using 1990s methods is why a lot of the fund managers do not outperform.
And regulation is all right. Regulatory clarity is not there.
I don't think there's a problem.
There's not a problem. If there are any questions, please identify yourself and please ask a question.
Good evening, Ms. Mehra. Good evening, Mr. Bhattacharya. My name is Siddharth. Lovely session. Thank you very much. My question has to do with international equity markets opening up to retail investors here in India. Right now, you can invest in American stocks, Hang Seng stocks, etc. Right? And you know, sometimes when I think through this, I'm like the MAFANG companies, for example, they're sort of owning the mantle on, you know, cloud deployment, AI, and it looks like they have a good job good prospects as far as the future is concerned. What would be your rule of thumb of sorts when a retail investor such as myself has to make a decision on, okay, time to look beyond the Indian equity markets now? What would be some of those rule of thumbs now that the other markets are so much more accessible to the retail investor?
Rule of thumb.
Rule of thumb is difficult to give, but one thing I would say, definitely do look at global investing. When I started my career, the dollar was 12 rupees. There's been an 85% depreciation in the course of less than a career. So any long-term financial planning you cannot do without looking at global investing. But global is not just the US, it is not just the 5 stocks that you know. And because this is a cause for me, because I think Indians do not look globally, and because we have been global for 25 years, and we were not just the first Indian, we were the first Asian firm to go global. We have a product that invests in all geographies, all asset classes, that actually starts at $10,000, that's 8.5 lakh rupees. Normally, you would not get access to that kind of product for less than $1 million. So that's like my contribution to this, because you know, asset allocation changes, geographies change. I just told you that 2003 to 7, emerging markets went up 4 times. During that time, US was an absolute laggard. Now, you know, 12, 13 years, US has done very well, but that will not last forever. Last 10 years, I was looking at that if you had put $100 in emerging markets, it would have become 150. In the developed market, it became 260. So that's been the gap. So sometime again, that cycle will turn.
That's right.
So you can't get locked in, and I'm repeating, US is not the world. So
that's right. Very good point. US is not the world.
Yeah.
Hello, ma'am.
Yeah,
My name is
go ahead.
Bhavik. And I have a question. You spoke about how to identify fraud sectors, and you gave a lot of good insights. My question is, what are the 2 top attractive sectors for you at this valuation where we stand at?
See, we do a base zero reallocation every quarter, because we don't say that we know for 5 years what's going to do well. As of now, where we are overweight, health and pharma, auto components, IT, and lately we have added in chemicals and FMCG, a sector that we were overweight for 3 years, we are for the first time underweight, which is capital goods, industrial machinery. So we entered far before the human fund managers did, which mostly they entered in 2023. We entered in October 21, but now for the first time we are underweight there. So broadly, that's where our PMS is currently.
Okay. Thank you. I think we cannot, already Ridhima is standing there looking at me. So, but I cannot let you go without asking these 2 quick questions and very short answers.
Right.
The gentleman there asked you about what are the sectors you must look at.
Right.
Can I ask you, what are the sectors that you must avoid?
I told you that we, for the first, I mean, I'm not saying avoid, but we are underweight capital goods, industrial machinery. We are almost always underweight banks and finance. I am always, somebody told me, Madam, aapka to takiya kalam hai, that I am a nervous investor in banks and lenders.
And my second question is, any domestic issue that bothers you?
As far as the economy is concerned, many.
Many.
Many, yeah.
Okay.
Starting with whether we will lose out on our demographic dividend because we cannot find jobs for our people.
Okay,
And ultimately that drives a lot of other things like consumption and so on.
That probably also explains your overall conservative approach to the stock market. Thank you very much for being so candid and so careful. And please give her a big hand. And you don't get market experts to be so frank and yet express their views.
I mean, many times people tell me that you are so honest, and I say it never occurs to me to say anything other than what I really think.
Yeah.
You know?
Thank you. Give it back to Devina. Yeah.
All right. Thank you so much. Can we give a huge round of applause for Ms. Mehra? And can I request Mr. A.K. Bhattacharya to present Ms. Mehra with a memento? All right, ladies and gentlemen, while we got some sound advice on investing, I think my big takeaway is getting the book Winning the Loser's Game by Charles Ellis. And I really like the phrase that ma'am used, that you will always lose some in equities, but don't lose big money. And don't put 100% in equities. You need a cushion for unexpected expenses like job loss or down payments. Set your equity allocation, but don't change it too often. And another interesting phrase that she used was, any business of judgment, system will outperform the human being. The next phraseology which really resonated with me is the fact that she said, US is not the world. And always do risk management first. That's why investing is a loser's game. You win if you don't lose. So first you will lose. You will have some interim losses, but you should not have big losses on your capital. I think very pertinent, very applicable.